Okay, hello everybody. I haven't made videos for a little while, and maybe it's a big relief for you. I have the reason I haven't been making any of these boring Excel type videos is I have decided to waste my time writing another book. And here's what I'm going to do. I am first going to limit this video to 20 minutes. I've got a timer on my uh, phone that I left at the coffee shop today. I have to go get. I am going to, if you want to watch more of these videos, there are going to be a whole bunch, and I'm not going to make any videos except videos about this book that I'm going to try to finish. And I am in getting there. Okay, and this video is going to be just a little bit of an overview view. I think I did one before, but this is real, much more real. And then I'm going to make ones that go chapter by chapter, and wherever 20 minutes, I'm going to stop, and I'm going to make a what you call this, a playlist. So if you use these videos to get to sleep, like I do sometimes, I listen to other German videos or something. I You can put a playlist and you can get to sleep then. Okay, and I'm going to start. And here's what I'm going to do this time. This In this book, I got a little radical. I said right somewhere up front here, I said I don't work for a bank or anybody else anymore. I don't really, I've been alone. I can say whatever I want. And I'm going to go through chapter by chapter. I'm going to begin by saying something I've said before, that finance is just at a ridiculous stage. It's like a magic potion that electricity was before Michael Faraday, or medicine was before Louis Pasteur. And then here's what I think I've learned, and you might be the same. By making financial models, and I'm not going to give you this, I wrote this really boring book before, this horribly boring thing. This time, I'm going to take the experience we have in making financial models, where I think we learn more than a whole bunch of other people when we struggle through our models, and we'll have some proofs. And here's what now I'm just going to go through some pictures. Here's a picture of a academic formula. What a lot of crap trying to put that in compared to a real model. And here's another formula for my bête noire, the McKinsey book. Here's my little thing about a doctor and a engineer and the finance person who said I started confusion. So I'm going to go through all of those, and then I'm going to talk about all of these things that I find wrong, some of the big subjects, and then I have 19 specific subjects I go through, and I'm going to go through those slowly, criticizing everybody from Standard and Poor's to Harvard case studies to McKinsey to investment bankers. And here I said, okay, I would love to have just taken some Harvard Business School studies, like this study that said Enron, quoted Enron as this fantastic company with this lady named Rebecca Mark, who was going to, it literally said she was going to be a missionary in India to spread the privatization gospel. I was going to do that. But I'm not. Instead, I'm going to work through issue by issue. Here are the chapters. A lot of them are kind of getting there. For example, I'll say, well, this man at Oxford said, oh, the IRR is bullshit. I'm going to respond to those, and I'm going to go through some issues about corporate finance first, and then show you how project finance can solve some of these things, and then spend some time talking about this absolute ridiculous rubbish on the CAPM and cost of capital. And it's not some theory about it. It's the fact that you can't find the inputs, and the inputs, we'll talk about it. Okay? And then I'll start. Here's where I'm starting. Now, all I'm going to do is go through some pictures here really quickly. I've already gone 5 minutes, but here's a picture of kind of the classic competitive strategy. You want to make a return above your cost of capital, you want to grow. And then these trite, disgusting, stretch the balance sheet whatever it is. Here's one, franchise value, all this crap. What it really means getting people addicted to your projects. I'm going to talk about that, and then we'll go through immediately just some simple math to demonstrate what the value driver formula and why in this matrix is the best part and this is the worst part to be. And we'll compare Amazon and the fact that Jeff Bezos paid his wife $38 billion compared to GE. Jack Welch, when GE was the most valuable company, he only paid like 100 million. 38 billion, 100 million. We'll talk about First Solar and this disaster of them being in the competitive strategy. And then I thought, no, that box was full of crap. It would be a much better box instead of just to talk about random growth, talk about investment. You have to make investments to grow. That's my big deal. And to think you can estimate the cost of capital, what a lot of crap that is. So instead of even computing the IRR, I've got this way to compute now. You'll think it's kind of crap because there's no little Excel function to do it, but I call it the risk premium earned method. Okay, we'll talk about that. There's a picture of the Queen, and she's got a handbag, and that handbag is made by my Uncle Gerald, and I'm going to talk about his business. He started selling out of a Volkswagen, and what he ended up with is a moderate company that makes these handbags, but in between he had all sorts of problems. He had to get out of businesses, and so I say, here's what what we would really say. This Square, it's great to be here, but people are going to copy you when you have a lot of risk. Here is the dangerous place where you have a bunch of surplus capacity from this one. And then you have to make this difficult decision to get out of businesses. And then the best place to be might be keep calm and carry on. A boring company, like a boring life. I'm going to argue that might be a different way of looking at things. And just to continue kind of this introduction, I quoted some things. Here's a thing where you just change the cost of capital by a tiny, tiny, tiny little bit, and it goes from 60 to 30. Oh, geez. What can we do about this cost of capital? And so then we move into the basic investment decision. 12 minutes left, okay. IRR is not perfect. Everybody knows that. But it's also the arrogance of these people to say it's bullshit. And, oh God, this NPV versus IRR argument that just used to frustrate. I just thought, what kind of crap is that? When the IRR is just the NPV, the discount rate, but it makes the NPV to zero, isn't it the same? But it's not. There's a nuanced real thing about this, and so I'm talking about what really is the IRR. And I'll use an example. I'll try to use some examples. My example is some man named Justin Bieber. Well, I've never heard a song of his, but he sold his songs to a private equity company of $200 million. How would we really value his songs? Okay, just a theoretical. I have no idea, obviously. But should we use NPV, IRR? And if we use NPV, the problem is that we change the cost of capital and we get a completely different decision. Okay? And maybe if we really want to figure out the cost of capital, we'll talk about that. Then I talk about what's this definition of IRR anyway. What is it? It's the growth rate. It's the growth rate when you can have this reinvestment headache that you have to deal with the growth rate when you reinvest at the cash flow. Now, if you had some different scenarios with different lifetimes of this Justin Bieber's songs and different growth rates, here's the NPV rule, the IRR. If the IRR is always reasonable, even if in different cases, well, unless they have to last more than 10 years, maybe they won't. Then you can use that kind of rule. Isn't that a better rule? Here's the problem with the IRR. If we go to a long life because of this reinvestment, the IRR just levels out really fast, and we don't have to make a fancy model to get there. And then I say, well, the MIR, what a lot of crap that is. And what's the next one? The multiple of investment capital. Oh my God, that's a payback period. Jesus. Those aren't very good, but here's something that I'm going to have you think about. I call it the risk premium method, where you first see what you would have made at the risk-free rate, and you take the cash flow you get, difference between that cash flow that you're actually getting minus the risk-free rate, you levelize it out and discount it at the risk-free rate itself, and you get how much risk premium that you actually earned. And I show you, well, then it's not so flattened out with the rates and all that. And then I move to chapter 4. And I say, what we want to do, I hope it was emphasized in the earlier chapters, we want to get an estimate of the cost of capital. Now, in the 70s, there was some wonderful Monty Python things about stamping out chartered accountancy. Oh, God, you got to look at some of those. Oh, and I'm arguing that's what you should do. Even if accountants can get comprehensive income, LIFO versus FIFO, what you need to do is get an estimate, and this is an estimate from some analyst report where we want to judge the historic returns, the future return. We want to be able to measure returns. And because of depreciation, impairment, asset write-offs, not using economic lives, there's so many things wrong, and you can't compute this famous ROIC that McKinsey loves so much. If you were going to compute it, the first thing you would have to do, and I go through this a little bit, okay, people are going to want to compute it, you better segregate out the balance sheet. I'm going to use Macy's that I studied a little bit in COVID. And Macy's claims, this store that's closing all their stores and had a disastrous time, they're claiming their return on invested capital is 17%. That illustrates the problem. The problem is they had a big write-off here, and after that big write-off, then the return goes up. And you can see I have a lot of writing in the meantime. And then I use Apple, and Apple had these billions and billions, hundreds of billions in cash. And how do we segregate their balance sheet and take away their cash and compute what their return on invested capital is, which is monstrous? And then how do we adjust for the fact that if you don't reinvest, your depreciation, your asset balance goes down, and that means your return on assets goes up? How do you adjust all of that? And show this McKinsey thing, which says, okay, let's use the return on invested capital. It means nothing. I'm going to go through all of this really slowly. Then I keep going after McKinsey a little bit here and show you they use 2,000 something references to the returns. But this is where I start moving to project finance as a better way to look at things. And I say a corporation is like project finance. A corporation is like all these children that have different stages of their lives, different returns, and we need to really understand a corporation. If we could get the returns for each of these people in the corporation, wouldn't that be good? Now, there are not a lot of nuances, but the central part about project finance is computing the IRR. And then I go through the things that says, okay, what's the difference between the IRR and the return on capital? And then what's wrong with straight line? And how can you compute something called economic depreciation, which is computing the value of an asset over time using as the discount rate the IRR itself? And when you do that, you can fix this. Here's the value over time. And if you look at this little thing here, this is the correct kind of return using economic depreciation that's the same as the IRR. And if we do that, we can measure performance better. And again, I'm not saying anybody can do this. I'm not saying anybody can do it. It's one of the lessons of project finance. It's one of the lessons of project finance, and it shows you just how much crap some of this other stuff is. And then I'm going through multiples. Well, everybody knows that multiples is bad, even though the investment bankers like to wave their magic wand. And I talk about Harvard case studies, and I remember one where people don't look at returns, and they had assumed that this case that the telecom company, that's a telecom crisis, was a good private equity investment in that period. Okay, and then I show you some examples of course, the crazy returns, but that's really, really not the point. The point is understanding with some of these, and again, going through some of these pictures, understanding why these things are so biased and why companies that almost look exactly the same could have a completely different price to earnings multiple or EV to EBITDA multiple. Here's just the multiple on a project finance that just goes down when you're finished. Life is over. I mean, you have no value. Here's I go through a little case with GE where they made a crazy forecast of the returns and they assumed the stock price would go up, of course, and it declined drastically. Then I go through the real fact that you can't use this famous McKinsey formula to really do any of these valuations. When you look at a PE, the biggest thing to look at is what's going to happen. What if you change the returns over time? What happens to the multiples? And then we have to make a little model, and I show you all the distortions on that one. But then it gets a lot worse with EV to EBITDA ratios, and I work through why, if you just have a longer term asset and you don't have to replace your assets that much and you have this straight line depreciation, why you get a completely different EV to EBITDA ratio. So imagine you have two exactly the same companies, but they have different depreciation rates. You get different things. I'm going through all of these kind of things, and hopefully a little more interesting in the book. And then the kind of the last chapter on the corporate finance and all the problems with corporate finance is the real elephant in the room of corporate finance, which is valuing a company forever. And that's more of a philosophical kind of thing. Anybody who claims that you can do this, and I start with my irritation on Corporate Finance Institute and Wall Street Prep and all these people's build a three-statement financial model. What a complete waste of time. You want to get the ROIC and the growth, not ROIC, the real returns. And I show you different methods and start with this horrible Gordon's method, which doesn't tell you what kind of return you're earning. It doesn't tell you anything. It's just a bunch of junk, okay, unless everything's stable. And I go through kind of how these models work and then what happens here if we start changing the growth rates and what kind of terminal growth models really can work. And I've talked about this before. We do a little interpolation of the returns and the growth rates, and show you how you have to be so careful with the capital expenditures and understand that to make a return, the return has to be consistent with CapEx. We have three things in it in any analysis: revenues, expenses, CapEx. Okay, working capital too. But that's what drives things. And if you leave the CapEx out, here's how you kind of fix it with the interpolation. Of course, so I'm going to go through this quickly. And then I say, okay, let's get away from the formulas. Let's get away from the bureaucracy. Beethoven. Here's Beethoven. Okay, let's, instead of valuing Justin Bieber's, whatever his name is, his music, let's value Beethoven's music. Pretend there was a private equity company. Now his music lasts a long time. Can you imagine if he would have monetized his? How would we have computed the value of something that lasts so long? And when you've got a component of some kind of uniqueness, or you can call it monopoly profit, that lasts for indefinitely, how can you combine that and understand how long that is going to last compared to going and finding new products with life cycles and replacing them? So we've got a couple of examples. Now I've got 1 minute left, so I'm going to stop here right now, and because my alarm is going to go off, and I'm going to continue next. And I hope I made that video.